While the majority of investors remain cautiously optimistic, believing the worst is yet to come, Warren Buffett stands apart. He has quietly issued one of the rarest and most urgent warnings of his entire career. It has already begun. This isn't speculation. This isn't about predicting a crash. Buffett is already acting. And when Warren Buffett moves, it's not based on emotion or headlines. It's based on structural truths the market hasn't yet fully priced in. The shocking part? What appears stable on the surface, open stock markets, functioning banks, confident governments, is, according to Buffett, a fragile illusion. Beneath it lies a slow but accelerating decay. And unless we understand what he sees, we may end up blindsided. So what exactly does Buffett know that others don't? Why is he raising cash, avoiding bonds, and preparing while most investors are still debating whether we're in a recession? Let's begin with the first and most overlooked warning Buffett has issued. The threat of inflation is not a phase, it's a systemic disease. The problem of inflation, Buffett said, is a terrifying one. It has recurred throughout history, and there's no perfect system to prevent it. Some governments, over time, just naturally debase their currency. He's not exaggerating. He's laying bare a truth few won't admit. Inflation is not a temporary glitch. It's not transitory. It's an invisible tax, and it doesn't announce itself with fireworks. It creeps into your daily expenses, erodes your savings, and makes even conservative financial planning look naive. For decades, developed nations were seen as immune to runaway inflation. But now, we're seeing record highs in cost of living, even in traditionally stable countries. Bread, rent, fuel, all rising faster than wages and faster than most conservative investments can keep up. This is where Buffett's mindset differs from the average investor. He doesn't measure success by how much you earn, but by how much value you retain and grow. If your bank account is growing numerically but losing purchasing power, you're not getting richer. You're falling behind quietly. Let's pause here for a moment. If you're finding value in understanding how one of the greatest investors of all time interprets current events, take a second to ensure you're subscribed to the channel. That way, you won't miss any updates or strategies that can help you protect your wealth in uncertain times. And if you've already subscribed, thank you. Your presence fuels this journey. Back to Buffett's warning. If inflation is a disease, what's the antidote? According to Buffett's model, it begins with two simple but powerful tactics. Raise your income and cut unnecessary expenses. Sounds basic, but in an inflationary spiral, both take on multiplied importance. Why? Because in times of inflation, every additional dollar you earn has double value. It helps you maintain your standard of living and gives you capital to deploy strategically. Buffett, after all, became a capital compounder because he always had a strong income stream, whether through business, investments, or royalties. In your case, that could mean launching a side hustle, leveling up your skills to earn more, or creating passive income channels. Every new income source becomes a shield and a weapon. Cutting spending, on the other hand, is like digging a moat. Buffett often says, it's not about how much you earn, it's about how much you keep. If you make $100,000 and spend $100,000, your net gain is zero. But if you learn to save even 10%, that becomes fuel for future investments, especially when markets dip. But here's the next layer of Buffett's thinking. Inflation is not only eating into your cash, it's rendering safe financial products useless. Government bonds, savings accounts, low-risk funds, they're no longer offering real protection. In many countries, their yields are lower than actual inflation. In short, even if you make no mistakes, if you follow all traditional financial advice, you're still losing. Buffett's logic flips the script. The real protection doesn't lie in any single investment. It lies in behavior, your consumption patterns, your ability to delay gratification, your ability to recognize value when the herd is panicking. That's how Buffett always wins in downturns. He accumulates when others sell. He thinks decades ahead. He understands that real wealth isn't built in bull markets. It's built when others are running scared. And we're just getting started. Because if you thought inflation was the biggest threat, Buffett's second warning is even more unsettling and more urgent. Before we move on, I want to know, what are you doing right now to protect your financial future? Share your thoughts in the comments. It might just inspire someone else. And if you haven't yet, take a second to like and share this video. It helps the channel grow and supports the creation of content like this. Warren Buffett doesn't warn the public unless something truly concerns him. So when he stated without hesitation that the fiscal policy of the United States is what scares me the most, the world should have listened. This wasn't a speculative comment. It was a red flag coming from someone who's navigated every major financial crisis for more than 7 decades. And this time, it's not a storm he sees coming on the horizon. It's one he believes has already begun. Let's break it down. The United States is currently running a fiscal deficit that exceeds 7% of its GDP every single year. That means the government is spending hundreds of billions more than it earns, with no real plan to close the gap. Unlike businesses, which can cut expenses or increase revenue, the federal government solution is simple. Borrow more, print more, and issue more bonds. Now imagine you're running your household like this. You make $50,000 a year, but you spend $53,500, and instead of adjusting your budget, you open a new credit card, then another. Eventually, your creditors stop seeing you as trustworthy, even if you haven't missed a payment yet. This is exactly what global markets are beginning to sense. The question isn't if the U.S. can pay its debts. It's how long it can continue expanding them without eroding the faith that underpins its economic strength. Because faith is everything in financial markets. Once it slips, it doesn't just impact one nation. It reverberates through every country, every currency, and every portfolio tied to the global economy. And here's the kicker. The U.S. dollar is the reserve currency of the world. So what happens if trust in the dollar starts to erode? You might already feel it. Rising interest rates, wild fluctuations in currency value, increased volatility in European markets. Central banks across the world, from the ECB to smaller national institutions, are holding U.S. treasuries, pension funds, institutional investors, private banks, all rely on the stability of American debt. But as inflation pressures mount and the Federal Reserve juggles political and economic constraints, confidence is thinning, slowly, subtly, but undeniably. Buffett sees this, and he's not taking chances. Instead of buying more government debt, he's stockpiling cash. Berkshire Hathaway recently surpassed $300 billion in cash reserves, the highest in the company's history. That's more than a quarter of the entire portfolio kept liquid. But why? Because liquidity is power. Buffett isn't sitting on cash because he's afraid. He's waiting, like a seasoned hunter. He knows that when the next market panic hits, and it will, he'll be ready to buy assets at prices others can't touch. While some investors will be forced to sell a loss just to stay afloat, Buffett will be on the other side of the trade, calmly acquiring value. For regular investors, this is a profound lesson. Build your liquidity. Don't see cash as idle money. See it as optionality, flexibility, resilience. Start with a high-yield savings account, a money market fund, or short-duration investments that won't lock you in. The point is to have dry powder, capital ready to deploy when opportunities arise. Now, let's take this a step further. Buffett isn't only preparing with cash. He's also doubling down on resilience. Look at his portfolio. It's not filled with high-risk, short-term bets. It's filled with companies that can weather any economic cycle. Companies with strong fundamentals, competitive advantages, and durable brand loyalty. Let's break that down. Coca-Cola. Even in recessions, people buy beverages. The company's global distribution, pricing power, and brand dominance give it a moat. Apple, not just a tech giant, but an ecosystem. Loyal customers, recurring revenue, and massive cash flows. American Express, a financial institution built on trust, partnerships, and consistent profitability across booms and busts. These aren't speculative plays. They're economic fortresses. Now ask yourself, what's in your portfolio? Are you holding assets that can survive a year with the markets closed? That's Buffett's test. If the answer is no, you may be more exposed than you think. Let's turn the lens back on the European investor. You might believe that U.S. fiscal issues are distant problems, but global markets are interconnected. If the dollar wavers, the ripple hits the euro, the pound, the franc, and the yen. Even Switzerland, with its reputation for stability, isn't immune to shifts in the global order. So what should you do? Here's what Buffett would advise, directly or indirectly. Reassess your portfolio. What do you actually own? Is it real value or hype? Reduce emotional investing. Chasing hot stocks and quick returns rarely ends well. Revisit your exposure to sovereign debt. Are you relying too heavily on instruments that promise safety but underdeliver in real terms? Prioritize liquidity and fundamentals over fear or greed. This is not about predicting doom. Buffett isn't sounding an alarm to scare people. He's preparing because he knows the math, the history, and the psychology of markets. And if there's one thing he's taught us over and over, it's this. Be fearful when others are greedy, and greedy when others are fearful. That moment of fear, it's coming. But there's one more layer. It's not just about inflation, not just about debt. It's about the currency itself. And what happens when people stop trusting the very foundation of their financial system? That's what we'll uncover in the final part. But before we continue, let me ask you something important. How many people do you know who still believe that everything will be fine just because it always has been? Who assume that bonds are safe, that governments will always step in, and that the system will somehow fix itself? If this video made you think differently, leave a comment below and tell us what part resonated most with you. Your thoughts help others challenge their assumptions, and they help us create deeper, smarter content. And if you're still not subscribed, take a moment now. Many of our most loyal viewers don't realize they've never hit that button. Make sure you're subscribed and turn on notifications so you never miss a moment that could change your financial future. Warren Buffett once said, "If you want to destroy the most productive economy in the world, you do it through the currency." This isn't a prediction. It's a warning, a subtle but resounding signal from one of the most disciplined investors in history. Most people look at inflation as a temporary annoyance, a phase, a policy mistake. But Buffett sees something deeper, a systemic decay that starts not in politics or policy, but in trust. Because money is not just a medium of exchange. It's a social contract, a promise. And when that promise begins to erode, so does everything built upon it. Inflation rarely arrives as a thunderclap. It creeps, quietly, invisibly. At first, it's just a little less bread in the same loaf. A few more cents at the gas pump, a delayed vacation. Then, over time, it becomes a profound realization. My money no longer holds the power it once did. Buffett knows this story too well. He studied it in post-World War I Germany, in Latin America during the debt crises, and yes, even in the United Kingdom in the 1970s. In 1976, Britain, once the financial center of the world, lost control over its currency. The pound plummeted, inflation hit double digits, and the government had to turn to the IMF for a bailout. It didn't happen overnight. It was a slow-burning erosion of trust. That's what makes it so dangerous. And that's why Buffett sounds the alarm, not with noise but with action. He doesn't hoard gold bars or rant about monetary collapse. He diversifies. He moves quietly into non-currency dependent assets, into global companies with cash flow in multiple denominations, into hard assets that governments can't print more of, into flexibility. If the dollar weakens, and Buffett is clearly preparing for that, the ripple effect is global. The euro, already tested during the 2011 crisis, and again during post-pandemic stimulus, will feel the strain. Even the Swiss franc, one of the world's safest currencies, is not immune if the global trust in fiat begins to fracture. So what can you do? Here are two powerful strategies to shield your wealth from this silent collapse. 1. Diversify your currency exposure. Stop depending on a single denomination. Spread your liquidity across at least 3 strong global currencies, ideally with uncorrelated fiscal policies. Buffett doesn't hold foreign currencies directly, but he invests in companies that earn in yen, euros, francs, and more. It's a shield built through operations, not speculation. You can mirror this by holding parts of your emergency fund in stable foreign currency accounts, using ETFs that track non-dollar assets, or allocating into multinationals with global revenue. 2. Hold non-government assets. Governments can inflate. Currencies can devalue. But gold, silver, and hard assets persist. Throughout history, Precious metals have retained value longer than any paper money. They don't yield interest, but they don't erode either. Even Bitcoin, while controversial, offers a form of decentralized value that governments can't touch, something we're considering in a truly diversified portfolio. Buffett may dislike cryptocurrencies, but the principle he follows remains the same. Keep a portion of your wealth outside of the system, especially when the system itself is under pressure. Ultimately, this isn't about predicting doom. It's about preparing for the obvious. The numbers are clear. Rising deficits, eroding purchasing power, fragile trust in government debt. You don't need a crystal ball. You need clarity and the courage to act. Buffett doesn't wait for crash. He moves based on fundamentals, long before the crowd reacts. That's why he thrives in cycles others barely survive. So here's what we've uncovered. The warning signs aren't loud. They're quiet. Inflation isn't random. It's structural. Currency risk is real and rising. Buffett isn't panicking. He's positioning. And you can do the same. Start by trimming excess spending. Build new income streams. Hold cash when others are burning it. Buy real protection, not promises. And above all, make your financial decisions based on logic, not noise. These are the actions that separate those who endure the storm from those who emerge stronger on the other side. If you've made it this far, you're part of a very small group who thinks critically and acts deliberately. Let others know you're that person. Leave a comment below with one insight you're going to apply from this video, and share it with someone who still thinks everything will work out eventually. Because while most wait for the headlines, Buffett and now you are already a step ahead.